84%. That is the exact percentage of all stock market trades now executed by predatory algorithms before a human can even blink. You aren't playing a game of skill, you're walking onto a battlefield with a pocket knife against a predator drone. The system isn't broken, it's performing exactly as it was designed. I'm Alex. This is Wealthonomics, where we expose the financial mechanisms the wealthy use to keep you in the dark. Last week we exposed how banks harvest your savings through the NIM gap. Today, we go where they really hide the bodies, the public exchanges. Most people believe the stock market is a democratic tool for wealth creation, a place where a smart person with a laptop can outwork the giants. This is a carefully manufactured lie. The modern market was fundamentally redesigned in 1975, a moment known as May Day, when the SEC abolished fixed brokerage commissions. While this sounded like a win for the little guy, it actually birthed the era of the retail product. You are no longer the client of the financial system, you are the liquidity that feeds the machines of the ultra-wealthy. To understand how you're being hunted, you have to understand the latency gap. While you wait for your mobile app to refresh, institutional firms like Citadel and Virtu have spent billions on fiber optic cables and microwave towers to shave microseconds off their execution speeds. They aren't predicting the future, they are seeing your order in the future and beating you to the punch by a fraction of a penny, millions of times a day. This is high-frequency trading, and it's a silent tax on every single dollar you invest. But here's what your financial advisor will never tell you. The public exchange you see on CNBC is only half the story. The real moves happen in dark pools, private exchanges where institutions trade massive blocks of shares away from the public eye. When a hedge fund wants to dump a dying stock, they do it in the dark where you can't see the price dropping. By the time that information hits your screen, the exit is already closed, and you're the one holding the bag. The part they deliberately don't teach in school is that fee-free trading is the most expensive thing you'll ever buy. When you use a zero-commission brokerage, you aren't the customer, you're the inventory. Your brokerage sells your order flow to the very high-frequency firms I just mentioned. They pay for the right to see what you're buying before the trade is even executed. They use your own data to front-run your positions, ensuring that every time you buy, you're paying a slightly higher price than the elite. Here's the thing that keeps middle-class families trapped generation after generation, the illusion of the long term. You're told to buy and hold for 40 years while the wealthy use 10-to-1 leverage to extract value from the market's volatility every single hour. They don't care if the market goes up or down, they care about the volume of the capture. They are the casino owners, and you are the player hoping for a lucky streak at a rigged slot machine. Everything I just told you is accurate. But there's a dimension to this story that almost no financial content creator covers, the index fund trap. You've been told that low-cost index funds are the safest way to grow wealth. In reality, index funds have become massive liquidity pools that institutional short sellers use to hedge their own high-risk bets. When you buy the S&P 500, you are providing the collateral that the 0.01% uses to leverage their own positions. You are literally funding the weapons used against you. Beyond the tech, there is the information asymmetry. While you're reading a 3-month-old earnings report, hedge funds are using satellite imagery to track retail parking lots in real time or scraping credit card data to see a company's revenue before the CEO does. They aren't investing in the way you think, they are performing arbitrage on information. By the time a hot tip reaches your Twitter feed, the profit has already been extracted, processed, and moved into an offshore trust. Let's talk about the leverage gap. A retail investor loses 10% and feels the burn. A hedge fund uses the repo market, which we touched on in EP10, to borrow at near zero rates, allowing them to turn a 1% market move into a 20% gain. They are playing with a different set of physics. They aren't smarter than you, they just have access to a gravitational well of capital that bends the rules of risk. This is why the gap between the S&P 500's performance and your actual net worth never seems to close. The system is further rigged through buyback engineering. Since 1982, it has been legal for corporations to use their profits to buy back their own stock, artificially inflating the price. This doesn't create better products or higher wages, it creates immediate wealth for executives and institutional shareholders who are compensated in equity. It is a legalized form of market manipulation that drains the company's long-term health to satisfy the short-term greed of the ownership class. You are watching a hollowed-out shell being polished for a sale. So, what do you actually do when the house always wins? You stop playing their game. The first step is moving from market participant to direct owner. This means looking for assets with zero counterparty risk and avoiding the high-churn environments where algorithms dominate. If you can't compete on speed, you must compete on duration and tangibility. This is about building a private reserve, a fortress of assets that the high-frequency machines cannot touch or front-run. You have to realize that your ambition is being weaponized against you. Every time you check your portfolio, you are engaging with a psychological Skinner box designed to keep you emotional and active. The more you trade, the more the house wins. True wealth is built in the silence, away from the ticker tapes and the breaking news alerts. The elite don't trade their core wealth, they own the systems that facilitate the trades. They own the land, the debt, and the infrastructure. 3 things to take from today. First, the stock market is a high-frequency harvesting machine, not a savings account. Second, fee-free trading is a data mining operation where you are the product. Third, your biggest disadvantage isn't intelligence, it's the latency of your information and your lack of leverage. Remember that 84% of trades are algorithmic? Here's what that actually means: you are competing against math, not humans, and math doesn't have a long-term strategy, it only has a capture rate. Next on Wealthonomics, why debt is the most powerful wealth tool if you use it right. If this changed how you see the system, subscribe. The next one goes deeper.